The latest figures show that on average, the monthly payment on a new car in the US in 2023 was $726. Now that's far from the true cost though, because when you factor in loan interest, depreciation, fuel, insurance and maintenance and fees, the total cost of ownership of a car has skyrocketed to the highest it's ever been at $1,015 a month, according to AAA. And given the average household income in the US is around $68,000, well, these payments are not trivial and count for 18% of the average monthly income, which puts car ownership as the second most expensive thing people spend their money on each month, second only to housing. So if you're asking yourself, how much car can I really afford in 2024? Then you've clicked on the right video. Whether you just want to know how much in total you should spend, or you're trying to understand the best way to finance a car, or if it's best to just buy it outright with cash. Or maybe you're wondering if there's a smart way to combine the two. And there is. But in this video, I'll explain the best practice for each of these areas so that you can drive off the car lot in your dream car without crashing into debt. And that's the level of humor you're going to get on this channel. So if you're new here, I'm Steve, a commercial finance manager for an S&P 500 company. And on this channel, we look at how we can use financial best practice to help fix our everyday money problems. The most basic guideline you can follow when buying a car is the 35% rule, which says that you shouldn't spend more than 35% of your gross annual income on a car. So for example, if you're on 50k a year, then the most you should spend on a car is $17,500. And if you were on 70k a year, then you shouldn't spend more than $24,500, and so on, as you can see here. Not only is this an easy rule to understand, it's also based on some solid financial principles. The 35% rule helps stop you overspending on a depreciating asset like a car. It ensures that a large part of your income isn't tied down to one expense, so that your money can be more balanced across other important things in your life. By limiting your car budget to 35% of your annual income, you won't need to take out a large loan that could strain your finances. This helps to avoid long-term debt and high interest payments. This rule helps you to keep to a lifestyle that's within your means. It makes sure that your car purchase doesn't compromise your ability to meet other important expenses like housing, food, and savings. Sticking to this rule can contribute to better financial health, leaving room in your budget for emergency savings. Cars often come with unexpected expenses, and having a financial cushion is absolutely crucial. By not overextending on a car purchase, you can give more resources to future financial goals like retirement saving, investments, or even buying a home. The 35% rule helps in setting a realistic budget based on what you can afford, not on market trends or pressures. It helps you make a choice that suits your financial situation rather than being swayed by the latest models or features. All that being said, for many, the 35% rule can be a little bit too aggressive because it can leave too little wriggle room for other expenses and financial goals, especially for people who only need a car to get from A to B. But it is a good rule if you're the kind of person who really values owning the best car that you can afford. And if you're willing to sacrifice other parts of your life for a great car, well then this rule might just be for you. For other people though, a slightly lower 25% is probably a better rule to follow. This leaves a lot more for other expenses and goals while still giving you enough leeway to buy a decent enough car. So to change our example, a person on a 50k a year salary should, under the 25% rule, not spend more than $12,500 on a car, 5k less than the 35% rule would have suggested. And if you're on 70k a year, then the max amount is now $17,500, as you can see on the table. Now, while the 25% to 35% rule gives you a quick and dirty way to understand what ballpark you're playing in when it comes to buying a new car, if you're thinking about financing a car, a more comprehensive approach is what we're going to look at next. But before we get to that, if you're getting any value from the video, please press the like button. It really does help. Thank you. The 24-10 rule. Now, this is the golden rule of car financing, and it's made up of 3 parts. Number 1, make a down payment of at least 20%. Number 2, finance the car for no more than than 4 years. And number 3, keep the total monthly expenses, which includes loan payments, insurance and fuel, below 10% of your gross monthly income. The requirement for the 20% down payment is based on sound financial principles and makes a lot of sense, because by putting down 20%, you're borrowing less, leading to lower monthly payments and less interest paid over the life of the loan. New cars, as we've said, depreciate really quickly. So a large down payment helps you avoid the negative equity or being upside down on your loan where you owe more than the car's worth. Again, a larger down payment can also secure a better interest rate as it reduces the lender's risk. And if you need to sell the car suddenly, then a larger down payment increases the likelihood that you'll be able to sell it for more than you owe on it. Another reason is that if you can't afford the 20% down payment, then it might be a sign that the car is outside your budget. Another benefit is that with a lower loan value, you might not need to opt for gap insurance, which covers the difference between the car's value and what you owe on the car if it's totaled. Ultimately, the 20% down payment is about reducing financial risk and making sure that the car purchase doesn't trash your finances. Now, the 4 in the 24/10 rule states that you should finance the car for no longer than 4 years. Again, this makes really good sense because a shorter loan term means you'll pay less in interest over the life of the loan, even if monthly payments are higher. Also, again, the fast depreciation of cars makes a shorter loan term help you build equity quicker, which reduces the risk of owing more than the car's worth. Another benefit is that you'll own the car outright sooner, which frees up monthly cash for other financial goals and investments. And on a related note, a 4-year term typically matches the period before a car needs major repairs or starts showing significant wear and tear. Finally, it discourages stretching for a more expensive car than you can afford, as the higher monthly payments of a shorter term can be kind of like a reality check. So in short, the 4-year term is about balancing affordability with responsible financial planning, ensuring that you're not burdened by a car loan for too many years. So last, the 10 in the rule is about keeping your monthly payments at no more than 10% of your monthly gross income, because limiting car expenses to 10% helps maintain a balanced budget, making sure that you'll have enough for other expenses like housing, savings and day-to-day needs. It's also a guardrail against overextending yourself financially on a depreciating asset. By not overcommitting to car expenses, you're better positioned to handle unexpected financial emergencies or changes in income. Staying within this limit can free up more of your income for savings, investments, or paying down other debts. It also helps in keeping your total debt to income ratio in check, which is beneficial for maintaining a good credit score and also qualifying for other loans. Keeping to this rule leaves room in your budget for other lifestyle choices and expenses like travel, dining out, or hobbies. In essence, the 10% guideline encourages a more holistic approach to personal finance, ensuring your car doesn't become a financial burden and aligns with your overall income and spending goals. So let's take an example. Suppose you're looking to buy a $20,000 car. So following the 24/10 rule, you should put down at least 20% or $4,000. If you finance the remaining $15,000 over 4 years at a 6% interest rate, your monthly payments would be about $350. And if you're making $50K a year, your monthly car expenses should stay under 10% of your monthly income, or in this case, $416, which in this example, it does. So given a 20% down payment and a 10% max monthly payment of your monthly income for 4 years, how much car can you actually afford? Well, here's a table showing a range of annual incomes against the maximum affordable car value, how much is left after your 20% down payment and the 10% monthly payment over a 4-year term. You can use your salary to find your limit and then aim lower if possible. The benefits of following the 24/10 guideline. Now, to show you the benefits of following this rule, let's take an example where I choose not to follow the 24/10 guideline and an example where I do follow it. In both cases, we'll be buying a $25,000 car with finance at an interest rate of around 8%. So in the first approach, I decide not to make a down payment, and so I'll be funding the car 100% through finance. This is expensive, so to keep the monthly cost down, I opt for a 5-year term on the loan instead of a 4-year term to spread the cost further. This brings my monthly payment to $507 a month. Over 5 years, this cost me a total of nearly $35,000, and the interest on that amount is $5,400. Now, let's assume this time I'm guided by the 24-10 rule. As before, the car cost $25,000 with an 8% interest rate on the loan. But this time, because I'm following the guideline, I put 20% as a down payment, or $5,000. I also keep the term to 4 years as recommended. Now, my monthly payment is $488 a month, and the total cost of the car is now $23,436. I've saved nearly $7K. Not only that, the interest now drops to $3,436. I've also saved myself nearly $2K in interest payments. So those are the kinds of savings you can expect if you do follow the 24-10 rule or any variation on it. But beware of the relationship between your maximum monthly payment and the term of the loan. Car dealers will do anything in their power to meet your maximum monthly budget, and they do this typically by offering to extend the term. But beware of this, because going over the 4-year period has a lot of implications that we've covered already above, like increased interest payments, owing more on the car than it's worth, as well as many others. So go in with your eyes open and keep in mind the principles behind the guidelines. While financing a car offers several benefits, like not needing a large upfront payment, allowing you to build a credit rating, and being able to drive a newer car than you probably could have afforded otherwise, it isn't without its drawbacks. Over time, you'll end up paying more than the car's value due to interest, and the car will depreciate quickly, losing value as soon as you drive it off the lot. You're also tied to a monthly payment, which can be a financial burden, especially if your circumstances change. So this leads to the benefits of cash buying. Paying cash for a car eliminates interest payments, immediately reducing the total cost of the vehicle. You own the car outright from day one, giving you complete control without any worry of meeting monthly payments. But it does come with its own set of drawbacks. Paying in cash requires a lot of money up front, and not everyone has $30K just sitting around waiting to buy a car. Even if you do, this could significantly crash your savings or your emergency fund, which might be needed for other important expenses or investments. The money used to buy a car outright could potentially be invested elsewhere for a better return, especially if you could have financed the car at a low interest rate. This is known as the opportunity cost, the loss of potential gain from other alternatives when one option is chosen. So it's important to balance the desire to avoid debt with the need to maintain financial flexibility and make the most of your money. But there is an alternative way that leverages the benefits of cash buying with the financial prudence of the 24-10 rule. So let's imagine you have $5,000. Instead of using it as a down payment on a new car, you buy a reliable used car outright for that amount. Yes, the car won't be anything special, but it's a means to an end. If you had used the $5K for a down payment to finance a new car, like the 24-10 rule example from before, there would be a $488 monthly repayment amount for 4 years that you'd be making. But now, while you drive the second-hand car around, you take that $488 and you bank it, or better yet, invest it. Doing that for 4 years would give you around $24,000 that you could then use to buy a pretty nice new car outright without the need to commit to finance with interest. Whatever approach you decide to follow, remember that the total cost of ownership of a car is more than the basic monthly repayment amount. There's also fuel, maintenance, insurance, tax, and depreciation to factor in. To get a good understanding of these factors, watch this video here by Nisha, who does a great job of describing all of these factors, as well as how you can decide between financing options when it comes to buying a car.